What's going on, YouTube? Welcome back to another video today. Today we're going to look at what I think are the best indicators to use. And most of you know, if you're not new here, I never used to be a big indicator guy, you know? It was all just strictly price action, support and resistance and whatnot. And then I kind of started to switch over to more of a systematical, whatever type of trading style. It just worked better for me, and I never tried it. So then once I learned about it, I tried it, really liked it. So best indicators. Why indicators are going to be really beneficial, especially these two. If you have a problem of, like, let's say you buy high a lot when you're taking your trade, right, or tend to sell the lows or stuff like that. These indicators are going to keep you on the right side. So if you are following the rules, obviously, but you're following the rules, you're always going to be buying low in the uptrend, and you'll always be selling high in the downtrend, which is best risk to reward. More than likely the best entry, the better entry. That's gonna do a higher win rate and stuff like that. So that's obviously gonna be good. And they're simple and easy. So that's kind of why these two specifically are going to be really beneficial and helpful and simple. They're incredibly simple. And then the other cool thing about using these two indicators is, like I was saying earlier, it's more of a systematic type of trading style. So it eliminates a lot of any sort of like human emotion, human error, which is a big part of trading. Besides over trading, but like marking your zones. Let's say you mark the wrong zone, or you mark a zone and then something happens at a different zone you didn't mark. So you change your mind and say, oh no, this is my zone now. So, like, let's say you marked, this level here, right, as your support. And if price got under there, then you would take a sell, okay? And then it's just an example. It's not something you would actually do, but let's just say you came to the charts before this stuff happened. You see this, you're like, okay, here's our support. Looks like we made a higher low. We should move back up. And you say, if we close underneath this zone, we'll take a sell. And then you close underneath, you take your sell. This one happens. Then after the fact, you're like, okay, maybe this, then the support or something like that. It eliminates all of that. So when you go back to look at your trade, it's not like, oh dang, I marked the wrong zone, or I should have did this here. The indicators don't change unless you change them. As long as you keep them the same, they are gonna consistently do the same thing every single time you're at the charts. And the way you execute and follow your rules is gonna determine kind of what you do right or wrong. So it eliminates that part, which is really cool, and that's what I like about it the most. Is it gets rid of any, like, objective of where your zones and stuff like that should be. It makes it a lot easier to make things consistent, which is very good. So about 4 minutes in, I suppose I can tell you guys what I'm talking about. So the ones we're going to talk about are the EMAs. So if you're looking at it, it'll be moving average exponential. Difference between exponential and the simple. Exponential is going to follow price a little bit quicker than the simple one would. So I like that better because because we're still using price action as like the main thing, and then these indicators that we're using here are our rules to how and when we can execute with confluence of what price action is doing. So the EMAs, we got the 15 and the 8. So those are my two that I think are just bread and butter. I know you can't say it, but the holy grail. I know it's not a thing, but they're really consistent. So what you're doing, and you can play around with the numbers, figure out what fits best for you, but these two are my favorite. So I get an hour and a half to trade the London session. From London Open for an hour and a half, I will look at chart. When that's over, I'm done. So I'm looking at the 15-minute, and then we got the 8 and the 15 EMA. So what these are telling you is when the 8 is above the 15, we are only looking for buys. Okay, so you're only looking to buy at a support. And if it's off of the EMA, great. You're more than likely a good chance, a good probability that you're buying low and not like buying high. So like you see this is moving up and there's no support being created. Price is just moving up. So you know, okay, I need to wait for a support. Price makes a support. Okay, there you go. Now you know that's a much better entry than just trying to enter up here, somewhere like that, or somewhere up here because we closed above this. So 8 above the 15 means you can take a buy. And then you just wait for a support to get created and you buy that support, stop under your support. Vice versa. The one thing with this before we move on to the sell version is when price is moving like this, still want price action to be moving pretty well. Okay, you don't want to trade it when it moves like that, or if you see stuff like this, when price action doesn't make sense, wait till the price action does make sense and then matches up with your EMAs. It's going to work out much better. So sells is just the opposite. So for buyers, we had the 8 above the 15. For sells, you just need the 8 under the 15. And that's kind of what you look at for sells. And then selling, obviously, you want to sell resistance. So bearish candles, you wait for resistance and you sell them. So those are the two EMAs. Quick little tips. What I've noticed from using them is when you get resistance, because these EMAs, right, they act as kind of a dynamic support and resistance. And for the most part, unless the trend changes, like something like this happens, it's going to keep you on the side of the trend for whatever time frame you're on. And you can use it 15, 30 minute, 1 hour. Totally up to you. I use the 15 just because of the amount of time I am on the chart. So when you see the lines, how it's kind of crossing through, making resistance, crossing through, making resistance, that's kind of what we want to see. Support here, and then a little double bottom, another support. So that's kind of what you're looking at. If it does it above it, let's say, let me see if I can find an example. We make a support above it and like kind of away from it. So like here, this guy, we kind of made a support and we weren't really touching the lines. That's okay. That just means we're going to be trending much better, because you see as we start to pull away from these lines, we start to move up even quicker. Like here we pulled away and we just kept moving. But the smaller numbers are going to keep it, they're going to follow price a lot quicker. So if price does quickly change directions, you are kind of able to participate in the move as it's starting to develop. Here we see this guy kind of came down, broke all our support. So we say, okay, maybe we look for sells. And we see this line, the 8 just came under the 15. And then we see our resistance created, but look, the 8's not under the 15. So even though we created resistance after we created a low, your other rules are not met. So you can't take that one, and then you get support. 8 is above the 15, and then you jump in some buys. So that's how you use it. That's what they are, why you use it, how they're beneficial, how they also tap into kind of helping with the psychology aspect of the trading. Hopefully you enjoyed it. I will have everything down in the description. And I'll see you guys in the next video.